There is no simple way to describe this, but 2022 has already been the worst year for stock purchases since the Great Depression in 1930, and some experts predict that trend will continue. For instance, the British pound just fell to a record low level. The bond market, which is traditionally seen as secure, had its worst year since 1949, and the Federal Reserve is currently raising rates more quickly and steadily than ever before. Not to mention that Congress is considering legislation that would impose a trading prohibition and restrict the securities that may be purchased and sold. So it is important to discuss the situation in detail. What this implies for you and how you could utilize this knowledge to your financial advantage. Since the source of all this mayhem can be summed up in just 2 words, interest rates, we must first discuss the situation right now. In a typical market, this is carefully controlled to maintain stable rates, stable consumer prices, and low unemployment. However, when inflation is at an all-time high and prices are spiraling out of control, there is nothing left to do but shut down the money printer, raise rates, and hope for the best, as is starting to happen in this situation. As you can see, aside from the 1970s stagflation era, interest rates have increased more quickly and significantly than at any other point in modern history. This is mirrored in the price you see every time you open your stock account, which may cause you to cry a little. The majority of people are also unaware that the Federal Reserve is purging its own balance sheet, which consists of mortgage-backed securities, corporate debt, and a range of other investments that are starting to be sold off, in addition to raising interest rates, placing even more decline on the market. And if that seems complicated, here's a very straightforward illustration of how that operates. The Federal Reserve intervened to purchase mortgages and corporate bonds during the 2020 pandemic in a bid to stabilize prices and prevent the market from dropping much worse. It's comparable to a whale entering the market, buying up all the existing shares, and then watching as the public invests as the prices rise. However, throughout this time, their balance sheet started to grow. However, regrettably, that can't continue forever, and unknowing to most people, they're starting to sell. One method of doing this is referred to as a balance sheet runoff, in which loans are repaid and the additional capital is simply taken and destroyed to remove it entirely from circulation. Although, as one analyst puts it, we're in the land of experimental monetary policy and we simply do not even know how this is going to turn out. Just as a seller could offload a large amount of a stock and cause the price to crash. The Federal Reserve also has to be extremely careful not to offload over the market could absorb. Because of this, investors are starting to accumulate cash and government-backed treasury bonds, which are now paying close to 4.5% risk-free for doing nothing. However, here's what you need to know regarding which investments would be most impacted along with Congress's investment restriction, because this is the aspect that I found to be the most depressing. The buy-dip method is where it all starts. This is the widespread belief that no one is capable of timing the market and that anything may happen. In the long run, it is far better to continuously buy so that you can ride the market over time. Considering that an average investor can't even surpass inflation over a 20-year period, every single stock market study has continuously shown that this is the most efficient way to accumulate wealth over the long term. However, this doesn't negate the possibility of short-term pain once investors buy the dip and then stocks continue to decline. 2022 has thus far, as I have indicated, been the worst year for buying the dip in over 100 years. The S&P 500 has lost 1.2% on average this year, which is the worst weekly loss of at least 1% since 1931, according to the Wall Street Journal. Let me know in the comments if you have any other questions about investing. Let's return to the video. They continue by saying that although buying the dip clearly proved to be a remarkably successful strategy, many investors were mistakenly disenchanted by the most recent stock market rally. In a balanced market, however, stocks could frequently decline for months or even years without any guarantee of eventually rising to their previous all-time highs. This presents a very realistic image of the fact that there will be years when investors lose money and even decades in which the stock market trades at zero, and that's entirely normal. In actuality, the market is in the negative 25% of the time, and a bear market recession has an average fall of 35% over 495 days. This would have been a terrific purchasing opportunity for individuals who aren't staying away from the market and are instead continuing to invest. For instance, even if we focus on the most recent example of the height of the dot-com bubble through 2012, it is clear that the market remained entirely flat over those 12 years. Using that case, your return would have been 4.66% over 12 years if you had just invested at the market's high and never again, but it would rise to 32% if you included dividends. However, if you regularly invested month after month, regardless of how it was trading, your total return increases to 24%, and when dividends were reinvested, it reached 42%. Congress, on the other hand, has a somewhat different perspective and is passing a trading restriction that is already starting to move through the system. This is an issue that has to be addressed. The Stock Act of 2012 is where it all started when it comes to the investment ban that is currently making its way through Congress. Most people are unaware that this is even occurring, so knowing that is important. Members of Congress are now required to publicly declare any stock purchases or sales they make, or spouses make as a result of this clause, which was implemented to assist combat market manipulation from within Congress. In this situation, if they make an investment that exceeds $1,000, they have up to 30 days to disclose it, or up to 45 days if it was done by a spouse or a third party. This implies that we can all see exactly what they're buying and selling and then imitate their actions. To determine the size of the return they actually received, he benchmarked those returns against the S&P 500 over a week, a month, and a year. He discovered that over the first month, they exceeded the benchmark by an average of 0.12%, over a quarter by 1.34%, and throughout the end of the experiment, their stock picks surpassed by almost 6%. Although they have an average of 30 days to report every trade, the median disclosure is made at day 28, and also the average is at day 52, which means that almost everyone waits until the very last minute to report their stock trades. Many of them file late and are assessed a $200 penalty, which is essentially just a slap in the face. But this is where things get really interesting. Nevertheless, even with everything on a 30-day delay, if you simply replicated their trades, you would still outperform the market. And here is where the issue starts. Currently, elected officials are free to buy and sell anything they want as long as they don't use personal data for financial gain. However, on September 13th, the New York Times published a report stating that from 2019 to 2021, over 1 in 5 members of Congress reported buying or selling a stock, potentially providing them with information about the companies whose shares they reported buying or selling. In one instance, the day before a House committee issued negative findings on the company's management of the 737 MAX jet, shares of Boeing were sold. Selling Wells Fargo shares a few months before, they gave a major warning to the bank, which caused its price to plummet. Another example involved trading cattle futures at a time when they were discussing the cattle market. That means 97 members of Congress in all were identified, and when they dug deeper, it is claimed that more than 3,700 trades disclosed by lawmakers of both parties offer possible conflicts between their public duties and private finances. Additionally, the New York Times is not the only media looking into these issues. According to a Twitter user, every member of Congress who beat the market in 2021 was named, and some of them even put Warren Buffett to shame. As a result, there is presently a proposal in the works to pass a stock trading ban, which would forbid any high-ranking officials from shorting stocks as well as investing in securities, commodities, futures, cryptocurrencies, and other comparable investments. It's also important to note that this has nothing to do with Democrats versus Republicans, because both parties outperformed the market by almost the same margin, indicating that it's a problem that affects the entire system and has to be fixed. But in terms of my personal opinions on everything that is happening, the problems with the market and what I'm doing to take advantage of it, here are my own methods that I believe might assist. I support investing bandwidth in Congress wholeheartedly because, let's face it, a flat $200 failure to report a penalty is nothing when some of these trades are making thousands or millions of dollars. I believe there has to be greater responsibility, more federal rules, and bigger fines. Again, to put that into perspective, if someone is worth $20 million, a $200 fine would be equivalent to someone worth $100,000 and receiving a $1 fine. So let that sink in. Now, even while I'm all for investing in index funds and ETFs in the real world, doing so would be a logistical headache. Because of this, I believe that a preferable option would be to simply notify all stock trades 48 hours in advance, allowing the public to buy before they do. Additionally, the failure to file penalties should be raised to a level that deters people from filing late in the first place. If the penalty were raised to 20% of the total investment, I can almost guarantee that no one would file late, because the penalty would be equal to their profits. But aside from that, even if the US Federal Reserve is lagging behind and investors are hoarding cash, the UK's currency is tumbling. It's crucial to keep in mind that in situations like these, the market is more led by fear than by logic. Yes, we are living in an unprecedented period. Yes, we are dealing with higher interest rates and inflation. And yes, no one knows what will happen. But generally speaking, the bottom will occur when everyone feels as though the world is collapsing and the markets are doomed forever. And that will present an excellent opportunity for anyone with the means to invest. It's also important to keep in mind that traditionally, September is the worst month of the year for the stock market, and that may have some influence. Since mutual funds' fiscal years conclude in September, many of them sell off their losing holdings at the end of the month in order to collect their taxes, which lowers stock prices even further. I'm continuing to decide to dollar cost average into the markets on a regular basis with the exact same amount I invest in a variety of US and international index funds. And I'm leaving enough cash on the sidelines to take advantage of a good real estate opportunity whenever it arises. I understand that it is never enjoyable to see your investments lose value, but it is a necessary part of the process. And the more you are aware of market trends, the better investor you may be. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.